Apple. Obviously, a lot of chatter on how the new phone introduction is going to save the day. The problem is the DSE is already overbought on the daily charts and falling hard on the monthly. So all this bounces up into this 50-day Bollinger Band and 200-day zone between 117 and 121. You can see here the 200 period over here on the weekly, the 200 period over here on the monthly, is that this is a bounce. Unlikely to go to a new high. Is it possible? It's possible. Let's see if it's probable. Let's see if we can find out a way to make it probable to go to a new high. I don't think it's probable. The reason is that there appears to be a 5-wave rally off Apple's (2001) low. 1 up into 2007, 2 down into 2008, 3 up into 2012, 4 down into 2013, and 5 up into this summer, and that 5 divides into 5 subwaves. 1, 2, 3, 4, 5. Well, why can't this be wave 4? Because if it's wave 4, then where's the wave 2? If this is the wave 2, then wave 4 and wave 2 are somewhat equal in size, but wave 4 is not supposed to break into the travel of wave 1. Is that a technicality? Well, it depends if you always use the rule or you never use the rule. That determines whether it's a technicality or not. We had, before the August 24th low, we had this pattern, a down, up, down ABC for wave 2. These, if you go to DSETRADING.com or Waveboom, you can see this Apple chart with this ABC has been the forecast well before this August low hit 92. In fact, the price is filling in the pattern very nicely. That was A, it's in B. B typically moves 50 to 75% back against the size of A. Apple peaked at 132, it went to 92, that's 40 points. 50% would be 20. That'd be 112. It's a little bit above that. 122 would be the 75% retracement. It actually could get up to 122 again. If it gets much above 122, odds are it's not a B wave. It might be 1, 2, or some other, or maybe B is going to be irregular and come up and make a new high before C. I don't know. What we do know is that the monthly stochastics are in hard down free fall conditions. The last time they were in hard down free fall conditions, Apple's price didn't bottom until the yellow box was visited, and that is months from now. Not days, not weeks, months from now. So odds are that this 92 is not as low as Apple is going to get in the next few months. The time before 2012 and 13 that the monthly Stokes went into free fall, they did pull themselves out of the bucket, but only later returned to the downside to find the yellow box at the bottom. This is not a condition under which the DSE would recommend buying actions. That is clear. That's clear. Now we have clarity. What about on a daily chart? Do we have confusion, or do we have clarity from the DSE's perspective? When stochastics are up above, when the daily stochastic is up above the 90% threshold, is that a condition that the DSE indicates is for buying actions or selling actions? I don't know. Let's assume we don't know. Let's go look. The last time the daily Stokes were up above, that was here. That would have been a really bad time to buy. How about the time before that? That was here. That would have been a really bad time to buy. How about before that? That was here. That would have been a really bad time to buy. How about before that? That was here. That would have been a bad time to buy. So, is this a bad time to buy? I don't know. 1, 2, 3, 4 historic data points that are beyond dispute tell us that in the past 9 months, it's never a good time to buy Apple when the daily stochastics are above the 90% threshold. Not once in the past, in the current calendar year, has a stochastic condition where we see it now been a good time to buy Apple. 4 out of 4, or 100% of the time, 1, 2, 3, 4, this has been a bad time to buy Apple and a good time to sell it. Therefore, what do you think the proper action based on objective data seen on this chart with no other emotional, human, any other input whatsoever, based on this chart using the DSE, at least one of the components of the DSE, what does this chart tell us? It's a one-word answer. The choices are buy or sell. Vote now. Sell. I think that is appropriate. Thank you for playing. Let's take it down to 122 minutes if you're an intraday trader. Stokes were up in this neighborhood. That was right here. Before that, that was right there. Before that, that was right there. Before that, that was right there. So on an intraday basis, if you're thinking, well, yeah, that's the daily chart, and I'm not really a multi-day trader. I'm really a multi-hour trader, so maybe I shouldn't pay attention to what the factual evidence on this chart, on the daily chart shows. I'll just buy anyway. Well, let's look at it in the 122-minute bar chart. That has been the wrong time to buy. Another notch, if you want. Go to the 31-minute chart. What typically happens when Apple's 31-minute stochastics get up towards the 90? Let's take a look. It sold off that time. Sold off that time. Sold off bigger that time. A little bit of sell-off this time. And sold off this time. Move it to the right. Sold off a lot that time. Sold off a little bit that time. Sold off a whole bunch that time. You see what I mean? So whether you're a daily swing trader that holds for 2 days to 2 weeks and use the daily chart, or whether you're a overnight trader that holds for 2 to 20 hours and use the 122-minute chart, or whether you're an intraday or shorter-term overnight trader of 2 to 8 hours and use the 31-minute chart, factual evidence without opinion, only by using eyeballs and comparing it to history, tells us that, at least for Apple, when stochastics are above the 90 threshold, an objective decision support model does never indicate a time to be buying or using buying actions. So if you're short and you're getting squeezed and you're uncomfortable because your short's going against you, this is not the time to buy to cover. Time to buy to cover was at 92, not at 116. Well, yeah, but it hurts now. That's not the market's problem, nor is it an objective decision support problem. That's a human problem, a subjective problem. Something happened in our humanness where we forgot to use buying actions down here. Well, that doesn't mean we should use buying actions up here because that would be the wrong decision. Objectively, we always want to make the right objective decision. And if it costs us money to learn the lesson, then maybe we'll learn it. Because, as we say here, there are only two ways to learn a lesson: through blood or through money. And sometimes it takes both. Stochastics are above the 90 threshold. Objective decision support model does never indicate a time to be buying or using buying actions. So if you're short and you're getting squeezed and you're uncomfortable because your short's going against you, this is not the time to buy to cover. Time to buy to cover was at 92, not at 116. Well, yeah, but it hurts now. That's not the market's problem, nor is it an objective decision support problem. That's a human problem, a subjective problem. Something happened in our humanness where we forgot to use buying actions down here. Well, that doesn't mean we should use buying actions up here because that would be the wrong decision. Objectively, we always want to make the right objective decision. And if it costs us money to learn the lesson, then maybe we'll learn it. Because, as we say here, there are only two ways to learn a lesson: through blood or through money. And sometimes it takes both. Someone's asking about using some Elliott wave labeling on the daily chart since the August 24th. Here's what that could look like. I can't say would look like because that would mean that I know what I'm talking about, and I don't. I'm only trying to interpret what the market's telling me, and sometimes I don't get it right. So here's what I think is likely happening. And I'm going to expand this because it's actually interesting to do so. I can't remember where this chart ended on the monthly. I'm going to go look at it right now so I can put this back in. About in the 60s, somewhere below 70. So now the daily chart is labeled like, although the color of the A and the B, this is how I would label the intraday swings of Apple since the August low. Actually, from the all-time high into the August low. Here's the subdivisions. Here's one way to use the subdivisions. I'm not saying mine is the correct way. I can definitely make another way if I had to right now. But this is in alignment with how the monthly chart is that I published before Apple tanked and still believe is reasonably accurate. Now, sometimes in corrections, because remember, somebody type in how many different corrective patterns there are within the Elliott wave theory. Again, we don't use Elliott except for a way to explain what the DSE is forecasting. Using Elliott by itself is a way to lose a lot of money in every manner you can imagine. But one of the patterns in the Elliott wave correction is a pattern such that the length of A and the length of C are equal. C equals A. We know that A is about 40 points. So from some new test of 118, let's say, today, tomorrow, if we drop 40 points off of 118, kind of gets us to 78. About 40 points. The next most common relationship between C and A is where C equals 1.62 times the length of A. 1.62. 1.62 times 40 is 60, almost 65 points. 65 points off of 118 gets us kind of in the 53 area. That's way, way down there. Let's see what that would look like. Somebody check my math. Is that possible? Oh yeah, that's just the bottom of this yellow box. That's the 2013 low. That's interesting, isn't it? So here, should take this arrow and move this arrow up to kind of 78. That's where C and A would be equal if we have got to move this up a little bit. C and A will be equal around 78. But C will equal 162 times A, around 53. And that just gets us back. What happened to my yellow box up there? Didn't I have a yellow box there? Huh. I thought I did. Let's put it back. So the two most common Elliott wave relationships between a C wave and an A wave are C equals A and C equals 1.62 times A, both of which are shown by this initial arrow. If we stop around 118 down to 78, and this arrow, we stop around 118 down here into 53 or 52 or whatever that is. The next most common after equality and 1.62 is for C to only be 0.62 times A, which means that wave C would only be about 24, 25 points from wherever this B wave ended, which means it could just, let's see, 25 points from, let's say here, would take it to 90. So it could just take out the low of this and look like a flat correction rather than a zigzag correction. You guys can go to the Google Elliott wave rules or guidelines and find out more definition of what it is I'm talking about. And you can also watch our Elliott wave component video in the resources page at DSETRADING.com. Now, if you're looking to get short or exit your longs that you are being saved in, the market's saving your losing longs that you bought up in the 130s, and you're looking for the place to get out, this pink box over the next couple months. Is the area, and we've just entered that area. Yellow box is where long-term support is. The DSE's forecast for wave 2, somewhere in here. Two. Use the bounce to sell, use this box to buy, and to make it even more clear, in this yellow box, this is the really ideal area to be scooping up your apple. If you want to be patient and wait, this area of apple is probably going to be, certainly it's the best buying opportunity since 2013. It may be the best buying opportunity for the next long time. Not sure. We'll find out. DSE will tell us when we get there. All right, have we beat Apple to death? I know that Caterpillar was requested. Let's move on to Caterpillar.